As Tesla has increased the popularity of driverless car technology, stocks like Uber and Lyft have taken a beating, but that's created an opportunity for long-term investors to capitalize on the lower valuation. But which one is the better stock to buy, Uber or Lyft? That's the question I'm going to answer in this video, comparing these two across revenue growth and cash flow from operations to sales, and then comparing them on valuation, measuring by the forward price to earnings, and measuring using my discounted cash flow valuation for Uber and Lyft. At the end, I'll tell you what I think is the better stock to buy between Uber or Lyft. So let's get started.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Measuring these two on revenue growth going back 5 years, we see very similar trends with very small differences that occurred at brief moments in time. Typically, these two share the same factors that drive growth, that drive expansion. And Lyft, while it's a more focused operator, focusing on only ride sharing and only in smaller markets, not smaller markets or fewer markets, whereas Uber focuses on not only ride sharing but also food delivery. And so that allows Uber a broader market opportunity, and it lowers its customer acquisition cost because if it acquires a customer, it can spread the cost across two segments, food delivery and ride sharing, which I think is an advantage in this type of business. In the most recent quarter, Uber generated 20% revenue growth, where Lyft generated 31.5% revenue growth. Each of these two have generated robust revenue growth in recent years, driven by the fact that people love the convenience of ride sharing. It lowers the cost of ownership of transportation, especially if you don't need to take a ride every single day. For instance, if you're working from home 1 day a week and commuting 4 days, you only need the ride sharing for 4 days out of your week, and the other days you don't need the ride share. And so in those situations, the cost of transportation could be lower for a lot of people depending on where you live for taking a ride share instead of owning a car. And it's also more convenient, right? You don't have to worry about parking and maintenance and filling up gas and repairs, etc., etc. If you are an individual, you don't have a family, ride sharing is an excellent option. For Uber, both sides of the business are thriving, both ride sharing and food delivery. People have grown accustomed to food delivery after they tried it during the pandemic, and they like it. They're willing to pay the fees to have food delivered. Sure, it costs more to have the food delivered to your home compared to going and picking it up, but it saves you a lot of time and it's a lot more convenient, and people over the years have demonstrated they're willing to pay for convenience. It can take you, in my city, up to an hour just to go 1 mile to your local Chipotle and pick up the meal that you ordered. Whereas you can have it delivered depending on the price of your order and pay a fee of, I don't know, $10, $15, but it saves you an hour. And for many people, after a long, hard day at work, they'd rather pay that $10 or $15 to have that time to relax instead of having to fight through traffic, find parking, wait in line, get the food, and then do the same thing back home. They'd rather pay that $10 or $15 and have the convenience of having the meal at home. And that's what's driving growth for Uber. These two have also done an excellent job of improving their cash flow from operations to sales ratios. They're both similar, with Uber at 15% and Lyft at 13.5%. They've reached this level by economies in scale growing large enough, and also by raising prices and reducing competition. I remember 5, 6, 7 years ago, 2019 and before, These two were competing so fiercely against each other with so many promotions and incentives, it was very difficult for them to generate any profitability, any cash flow. Those promotions and incentives have been reduced significantly. I don't notice many coupons and emails anymore from Uber or Lyft offering a free ride or a 40% discount on a ride or a 50% discount on a food delivery order. Whereas in 2019, I used to get those all the time from all of these food delivery companies and ride sharing companies. Every day there would be emails with promotions. Those have subsided for the most part, and they've also raised prices. And so the combination of that has driven improved profitability for Uber and Lyft. All right, now let's look at valuation. And measuring by the forward price to earnings ratio, Lyft is significantly cheaper at a forward PE of 9.8, while Uber is trading at a forward PE of 16.7. They are both relatively cheap, but Lyft looks cheaper than Uber according to this calculation. Looking at my discounted cash flow valuation model, my intrinsic value calculation for Lyft is $19 and the current market price is $13.78. So again, more evidence that this stock is undervalued. And a similar story with Uber, I've calculated the intrinsic value per share at $112, whereas the current market price is $68. Again, highlighting undervaluation for Uber. Of course, the big risk for these two is the threat of driverless car technology, but I've talked a lot about how that might not be a negative for either Lyft or Uber. The rider expense is a big cost to both Lyft and Uber. Lyft and Uber have to pay the driver for every ride that's ordered. So for every incremental revenue on, well, I shouldn't call it revenue, it's called booking. For every $10 that a customer spends on Lyft, they have to share that with the driver. Imagine if they don't have to share it with the driver, if the cars are driverless. Wouldn't that improve the profitability, or wouldn't that improve the business? Maybe it will. Maybe it won't if the driverless car is completely owned and operated by different companies like Tesla and other car companies, and they're not partnering with Uber or Lyft for any of that ride sharing, and they're not willing to license the technology. In that worst case scenario, sure, it could be big damage for Lyft and Uber. My expectations are that it's going to take much longer for driverless car technology to be implemented in the United States at a large degree. Of course, we have driverless cars on the road right now, but they're in just a few cities like Los Angeles, San Francisco, Phoenix, and they're expanding slowly. And right now, it's Tesla's not in the driverless car business. They hope to be on the road soon, but they've been saying that for a decade. So we don't know when, and I'm expecting that to take longer than expected. So I like these two stocks. I have them both rated as a buy. But if I had to pick one of them, I would pick Uber as the better stock to buy. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.